What is day trading and how does it work? Every day, millions of people around the world try to beat the market, but not by investing long-term or buying index funds. No, they do something much faster and riskier. They're called day traders. But what exactly is day trading? And more importantly, how does it work? Let's break it down. Day trading is the practice of buying and selling financial instruments like stocks, options, or cryptocurrencies within the same trading day. The goal? To profit from small price movements, usually over minutes or hours. No overnight holding, no long-term strategy. Just fast trades, high volatility, and rapid decisions. Sounds exciting? It is, but it's also incredibly challenging. How does day trading actually work? At the core of day trading is a simple principle: buy low, sell high, but do it quickly. Day traders use real-time data, charts, and technical indicators to try to predict short-term price movements. Let's say a stock opens at $100 in the morning. A day trader might notice a pattern that suggests it could spike to $105 within the hour. They buy in at $100, ride the wave up, and sell at $105. That's a $5 profit per share in a matter of minutes. Multiply that over dozens of trades per day and you can see why it's appealing. But here's the catch: it can go the other way just as fast. A bad trade can wipe out hours of gains. That's why successful day traders are highly disciplined. They set strict limits on losses, take profits quickly, and never let emotions drive their decisions. What tools do day traders use? Day trading requires more than just an internet connection and a trading app. Professional day traders use direct access trading platforms for lightning-fast execution, advanced charting tools to spot patterns in real time, Level 2 quotes to see market depth and order flow, news feeds that deliver instant updates that could move markets. Timing is everything in day trading. Being seconds late can turn a winning trade into a loser. Do you need a lot of money to start? In the US, there's a rule called the pattern day trader rule. If you execute 4 or more day trades in a 5-day period using a margin account, you're considered a pattern day trader and you'll need to maintain at least $25,000 in your account. However, there are ways around this. You can trade with a cash account, trade forex or crypto, which often don't have the same restrictions, or start with simulators to build experience without risking real money. What are the risks? Let's be clear, day trading is risky. Studies show that most beginner day traders lose money. Why? Because it's fast, emotional, and extremely competitive. You're not just trading against other beginners. You're up against institutions, algorithms, and pros with decades of experience. That said, with education, discipline, and the right strategy, some traders do make it work. So, is day trading for you? Ask yourself, can I handle fast-paced decision-making under pressure? Am I okay with losing money, especially in the beginning? Do I have the time to monitor the market during trading hours? If the answer is yes, day trading might be worth exploring, but start slow, use demo accounts, and treat it like a skill to be learned over time. Day trading isn't a get-rich-quick scheme. It's a full-time job for many, and a serious hobby for others. Done right, it can be rewarding. Done wrong, it can be costly. If you found this breakdown helpful, give us a like and drop a comment below. Have you ever tried day trading, or are you thinking about it? Let us know. And remember, this content is for informational purposes only and does not constitute financial advice.